In global finance, investors are always searching for the next big opportunity, constantly scanning the horizon for places where their money can work harder and deliver bigger returns. They look for markets where growth is accelerating, where economies are transforming, and where their investments might grow faster than in established markets like the US or Europe. This quest often leads them to what are known as frontier markets, countries that are less developed than emerging markets, but bursting with untapped potential and rapid growth prospects. Think of frontier markets as the younger siblings of major economies, smaller, riskier, and sometimes unpredictable, but full of promise and energy. These are places where innovation is happening on the ground, and where entrepreneurs are building the foundations of tomorrow's industries. Their stock markets are often small and not very liquid. Their currencies are less traded on the world stage, and their political environments can be less stable and more volatile. But for adventurous investors, these very challenges are what make frontier markets so appealing. The risks are high, but so is the potential for outsized rewards. Because these markets are often off the radar of mainstream investors, asset prices can be low, creating opportunities for significant growth as these economies mature and attract more global attention. Investing here isn't for the faint of heart. It's high risk, and the ride can be bumpy, but the rewards can be substantial for those willing to take the plunge and weather the volatility. With steady but unspectacular returns in developed markets, big funds and global investors are now looking further afield, searching for higher gains and new frontiers to explore. This risk-on mood has turned attention to nations just opening up to global capital, like Uganda, which is now on the radar of international investors seeking the next big thing. Once overlooked, Uganda now stands out for its growing economy, disciplined central bank, and a government that's working to create a more stable investment climate. For investors willing to do their homework and take calculated risks, the potential for high returns is real, and the excitement of being part of a country's growth story is hard to match. Uganda's rise is a prime example of how the appetite for risk is reshaping the global investment landscape, and why frontier markets are capturing the imagination of investors worldwide. Uganda has seen a dramatic surge in foreign investment, with nearly $3 billion now in its debt and stock markets, a leap from under $1 billion just a year ago. Foreign investors now own about 12% of all Ugandan government bonds, a clear sign of their growing influence. The influx isn't just from traditional funds. Hedge funds, known for high-risk strategies, are now major players. Their presence brings both capital and volatility, as they can exit quickly if conditions change. This wave of investment is transforming Uganda's financial landscape, providing vital funding for infrastructure and public services. It's also deepening local capital markets, making them more efficient. But with rapid inflows come new risks. Uganda's economic managers must balance opportunity with the potential for instability. The challenge: harnessing this capital while guarding against the dangers of fast-moving global money. Why Uganda? It's a mix of stability, high yields, and credible economic management. The Bank of Uganda stands out in the region for its disciplined approach to inflation and stability, earning investor trust. The Ugandan shilling has shown resilience, protecting foreign investors from currency losses. High yields on government bonds, much higher than in developed markets, are a major draw, especially with global interest rates low. Investors are being well compensated for the risks of a frontier economy. Uganda's broader economic policies have also been prudent, despite political challenges. This combination, credible central bank, stable currency, and sound fiscal management, creates a compelling narrative. For investors seeking high growth and manageable risk, Uganda checks all the right boxes. It's become a standout destination in the global hunt for returns. A turning point came in June 2025, when the World Bank resumed funding to Uganda after a nearly 2-year freeze. The freeze, triggered by a controversial law, had cast doubt on Uganda's international standing and access to development finance. The World Bank's return was seen as a green light by investors, signaling that the worst political fallout had passed. This move restored confidence, unlocking a flood of private capital. For investors, the specifics mattered less than the message. A major global institution was backing Uganda again. The World Bank's seal of approval removed uncertainty and encouraged hesitant investors to act. This re-engagement was a catalyst for the billions now flowing into Uganda. Most foreign capital is flowing into Ugandan government bonds. These are financial instruments that play a crucial role in the country's economy. Essentially, when investors buy these bonds, they are lending money to the Ugandan government in exchange for regular interest payments over a set period of time. The funds raised through these bonds are used to finance vital development projects, like building new roads, expanding schools, and constructing hospitals, helping to improve infrastructure and public services across the country. This process expands the government's access to much-needed capital, allowing it to invest in the nation's future and support economic growth. For investors, Ugandan government bonds are attractive because they offer relatively high interest rates, which serve as compensation for the risks involved in investing in a developing market. The focus is mainly on bonds issued in Ugandan shillings, the local currency, rather than in foreign currencies. This means that investors are not only exposed to the risk of the government defaulting, but also to fluctuations in the value of the Ugandan shilling, known as currency risk. To participate, foreign investors must convert their dollars or other currencies into shillings, tying their returns to the performance of the local currency. If the shilling weakens, their returns can shrink, but if it holds steady or strengthens, the investment can be quite profitable. This steady demand for local currency bonds helps to strengthen Uganda's financial system, making it more robust and dynamic. However, it also increases Uganda's sensitivity to shifts in global investor sentiment and international financial trends. If global conditions change or investors lose confidence, they might pull their money out suddenly, which could destabilize the economy, causing sharp swings in the currency and financial markets. The government benefits from lower borrowing costs and increased funding for development, but the stakes are high, and the risks must be carefully managed to avoid sudden shocks. Uganda must now walk a delicate line, attracting foreign capital to fuel progress, while also maintaining economic stability and protecting itself from volatility. The influx of foreign investment is both a powerful opportunity and a potential vulnerability, shaping Uganda's financial future in complex ways. The benefits of foreign capital come with serious risks. While the influx of international money can boost Uganda's economy, it also exposes the country to new vulnerabilities that must not be ignored. The biggest threat is capital flight. Money that arrives quickly can leave just as fast, especially with hedge funds involved. These investors often chase short-term gains, and their decisions can be influenced by events far beyond Uganda's borders. If global sentiment shifts, investors could dump Ugandan bonds, causing the shilling to plunge and inflation to spike. Even a rumor or a sudden change in global markets can trigger panic selling, putting enormous pressure on Uganda's financial system. This could trigger a financial crisis if the government and banks aren't prepared. The shockwaves could ripple through the economy, affecting businesses, jobs, and everyday life for Ugandans. There's also the risk of capital controls. Uganda might restrict money leaving the country in a crisis, trapping investors' funds. Such measures can damage the country's reputation and make future investment less likely. Broader risks loom. A global recession or a stronger US dollar could send investors fleeing to safer assets. Uganda's economy is now more exposed to shocks from the world's largest economies, making it harder to predict what comes next. Falling commodity prices could also hurt Uganda's economy and scare off investors. Since Uganda relies on exports like coffee and oil, a drop in prices can quickly reduce national income and investor confidence. Liquidity is another challenge. Smaller markets can be hard to exit quickly, as seen when BlackRock liquidated a major frontier market fund. Investors may find themselves unable to sell assets when they need to, amplifying losses. Uganda's fortunes are now tied to the volatile moods of global finance. The country must navigate these unpredictable waters with caution and foresight. The rewards are high, but so are the dangers. Every opportunity comes with a potential downside, and the stakes have never been higher for Uganda's future. Managing these risks is now central to Uganda's economic future. Careful planning, strong institutions, and constant vigilance will be essential to ensure that foreign investment brings lasting benefits, not just fleeting gains. Political uncertainty is a major concern as Uganda heads toward its 2026 presidential election. President Museveni's long controversial rule has provided stability, but the upcoming vote brings unpredictability. Investors worry about potential unrest, protests, or a contested result. Any instability could shatter confidence. Past elections have seen heavy security and disputes, serving as a warning to today's investors. Political risk is a key reason Ugandan bonds offer such high returns. As the election approaches, investors will closely watch for signs of tension or instability. The government's handling of the opposition and the fairness of the process will be scrutinized globally. The election's outcome will determine if Uganda's investment boom is sustainable or just a fleeting phase. Uganda's investment surge is part of a global trend. Capital is flowing into frontier and smaller emerging markets worldwide. Countries like Egypt, Nigeria, and Kazakhstan are also attracting foreign money with high yields and reform efforts. Major banks like JP Morgan are encouraging bets on local currency debt in these markets, making such investments more mainstream. As more investors pile in, markets become more liquid and attractive, creating a self-reinforcing cycle. A weak US dollar and supportive global markets have fueled this risk-on environment. The main emerging market bond index recently hit record highs, up nearly 17% in a year. This isn't just Uganda's story, it's a worldwide phenomenon. Investors are increasingly comfortable venturing into riskier markets in search of profit. Uganda's rise as an investment hotspot is a classic story of risk and reward. High yields, a credible central bank, and World Bank support have unleashed a torrent of capital. But the influx of fast-moving money brings instability. Capital flight, political risk, and liquidity challenges loom large. The 2026 election is a critical test. Any unrest could send investors fleeing. This dynamic defines frontier markets: immense growth potential, but unpredictable dangers. For now, the rewards seem to outweigh the risks, and investors are betting on Uganda's promise. But it's a high-stakes gamble for both investors and the country. The coming months will reveal if Uganda can turn this moment into lasting success, or if it's just a brief chapter in the global search for yield. The world is watching to see if Uganda's gamble pays off.